ARM jumped 10%. Lab scores at 71 out of 100. Why? Hyperscalers are rushing to adopt the new Neoverse v3 platform. By deploying these pre-integrated compute subsystems, cloud giants can shave up to 2 full years off their custom silicon design cycles. Our full teardown reveals how this architectural shift permanently expands ARM's high-margin royalty streams. ARM is an irreplaceable bottleneck core because it's v9 architecture, the latest instruction set architecture that defines how software communicates with hardware, commands up to double the royalty rates of legacy designs. While Wall Street obsesses over handset volume, the real engineering win is in custom silicon like Microsoft's Cobalt and Google's Axion. These chips utilize ARM's Neoverse v3 platform, high-performance compute blueprints designed specifically for data centers, to bypass standard off-the-shelf limits. When you compare this to Intel's x86 architecture, the competing complex instruction set design used in traditional servers, ARM wins on power efficiency. The engineering reality is simple. x86 struggles with the thermal density of AI racks, while ARM's RISC, reduced instruction set computer, foundation scales without hitting the TDP wall. Thermal design power, the maximum heat a cooling system must dissipate. The lab views ARM's hardware moat as a structural royalty engine that captures value regardless of which hyperscaler wins the AI war. Today's 10.04% move to $376.59 is the market pricing in this shift from mobile-centric units to infrastructure-grade licensing. We are seeing v9 adoption accelerate in the Apple A18 and MediaTek Dimensity 9400, which are the first mass-market chips to fully leverage ARM's confidential computing, a hardware-level encryption that protects data while it is being processed. Even with RISC-V, the open-source instruction set architecture that poses a long-term threat, at least 5 years away from meaningful server adoption, ARM remains the only viable path for custom silicon. Today's price action confirms that the silicon reality of v9 royalty expansion is finally outweighing the macro noise of the hawkish Fed. Quarterly financials showing modest revenue momentum for ARM. By Q4 2026, the Fed's hawkish pivot will compress ARM's valuation multiple by at least 15% as the cost of capital forces a repricing of high beta equities. With a beta of 3.79, a metric indicating the stock is nearly 4 times as volatile as the S&P 500. ARM is hypersensitive to the 10Y yield hitting 4.55%. While EPS grew 47.9%, the Fed is tightening the liquidity environment just as the yield curve is normalizing, the process where long-term interest rates rise above short-term rates after a period of inversion. This normalization increases the discount rate applied to future cash flows, punishing companies with extreme valuations. Despite the 10% jump today, the macro friction is real. CPI at 0.6% YOY suggests inflation is sticky, keeping interest rates higher for longer and squeezing the R&D budgets of ARM's largest licensees. The geopolitical landscape is the secondary friction point that Wall Street treats as a footnote. U.S. export controls now explicitly block the licensing of Neoverse V-Series cores, ARM's highest performance processor designs, to Chinese entities like Alibaba and Biren Technology. This isn't just a regulatory hurdle. It is a direct hit to high-margin royalty streams in a region that is now forced to accelerate RISC-V alternatives. Simultaneously, the threat of renewed tariffs and trade war uncertainty under current policy shifts introduces a 7.6% recession risk according to prediction markets. While the market cheered the 10.04% gain to $376.59, the corporate narrative ignores the linguistic shift in filings where geopolitical tension has replaced market expansion in the risk sections. ARM is a technological titan caught in a macro vice, where supply chain resilience now dictates the winners over pure growth. ARM reported earnings per share of $0.60, beating the Wall Street estimate of $0.59 by 2.1%, a solid beat that signals strong execution. ARM IP licensing is trending higher at 376. Segment 3, the PR Insider Filter, ARM management's headline this quarter. The value gained by accelerating time to market outweighs anything that customers are considering. That's the phrase they want you to remember. Designed to make you feel ARM's pricing power is untouchable, that bill of materials pressure doesn't exist, and that every customer is racing to adopt V9 CSS, their premium architecture, no matter the cost. What they're not saying, memory market weakness, smartphone unit declines, or the fact that their royalty growth guidance is being propped up by one-time comps from a MediaTek chip last year. Now flip the table. Insider selling isn't just happening, it's a hemorrhage. Colin Spencer alone dumped $19.8 million in the last 90 days. That's not a diversification strategy. That's a founder-class executive who sees the same royalty growth slowdown we do and is cashing out before the street catches on. Historically, this pattern precedes a 15 to 20% drawdown in the next 2 quarters. The EPS beat? A rounding error, 2.1% above estimates, while R&D as a percentage of revenue ballooned to 56.4%, up 34% YOY. That's not efficiency, that's desperation. ARM is burning cash to outrun commoditization, and the silicon reality is brutal. Their V9 CSS royalty bumps are being eaten alive by smartphone unit declines. Management says memory impact is minimal. The transcript says otherwise. At most a 4 to 6% revenue impact from units alone, before accounting for the royalty hikes they're banking on. That's not a growth story. That's a margin squeeze in disguise. The Q&A is where the cracks show. The momentum breakdown for ARM. RSI sits at 60, pointing to bullish momentum, with buyers in control. MACD is currently bearish, with downward histogram pressure. The bull case for ARM rests on the massive ramp of the Neoverse V3 platform and compute subsystems, pre-integrated blocks of IP that allow hyperscalers to skip years of design work. By integrating these with HBM3E, high bandwidth memory that delivers over 1 terabyte per second of data throughput, AWS and Microsoft are locked into ARM's high-margin V9 royalty structure for the next decade. But here's what breaks the bull thesis. ARM's trailing P/E of 437.9x leaves zero room for execution errors. The export controls blocking V-series cores from China aren't just a headwind. They are a structural amputation of ARM's fastest-growing market. If Windows on ARM PCs fail to gain 10% market share by year-end, the consumer electronics slowdown will crater the stock. The pro-level question is this: how does ARM defend its moat when its largest customers are the ones funding the RISC-V ecosystem to escape ARM's royalty tax? The lab's answer is that ARM isn't selling an architecture, it's selling time to market. Hyperscalers will pay the royalty today to win the AI race, but they are building the exit ramps in the background. With a bearish MACD, moving average convergence divergence, a trend following momentum indicator, today's volume decline of 20% suggests this rally lacks conviction. If ARM holds support at $209.16 through the next earnings cycle, expect a retest of $411.83 as V9 royalties hit the bottom line. However, if licensing revenue from China drops another 15%, we see a downside target of $242.92. The lab's call: ARM is a hold with an AI score of 71 out of 100. The technical wedge is tightening, and the macro friction is too high to chase this 10% move. Intel jumped 8%, scoring 63 out of 100. Buy. Street analysts are finally pricing in the massive hardware gamble on high-NA EUV lithography. Reclaiming process leadership with the critical 18A node represents their ultimate multi-billion-dollar survival play. Our full teardown reveals whether this high-stakes silicon pivot can actually deliver the margins investors expect. Intel's hardware position is a liability until the Intel 18A node, the 1.8 nm class manufacturing process that replaces FinFET with Ribbon FET, hits high-volume manufacturing yields above 60%. While the stock jumped 8% today to $126.30, the silicon reality is a desperate race to deploy high NA-EUV, high numerical aperture extreme ultraviolet lithography, a $380 million machine that uses larger lenses to print features smaller than 8 nanometers. Intel is betting its $635 billion market cap on being the first to master this optics shift before TSMC's N2 node, the 2-nanometer process that will also use gate-all-around transistors. If 18A fails to hit its power performance area targets, the architectural lead shifts permanently to external foundries. The engineering constraint isn't just the transistor, it's the power delivery. 18A introduces power via a backside power delivery network that moves power traces to the bottom of the wafer to reduce IR drop, which is the voltage loss caused by resistance in the metal layers. This allows for higher clock speeds without hitting the TDP wall. Thermal design power. The maximum heated chip is designed to dissipate in watts. Today's price move reflects market optimism for the Lunar Lake ramp, but the real test is the Clearwater Forest CPU. That chip utilizes Fovero's Direct, a copper-to-copper bonding technology that enables 9-micron bump pitches for massive interconnect density. Engineering leadership is currently priced as a certainty, not a probability. Quarterly financials showing modest revenue momentum for Intel. By Q4 2026, the hawkish Fed pivot will compress Intel's valuation multiple by at least 15% as the cost of capital for its massive multi-billion-dollar fab expansion rises. With the Fed rate at 3.63% and the 10-year yield at 4.55%, the era of cheap liquidity for semiconductor infrastructure is over. Intel's R&D budget is under direct pressure as the yield curve continues its normalization, the process where long-term interest rates rise above short-term rates to reflect a standard economic outlook. Prediction markets currently price recession risk at 7.6%, but the real friction is the 0.6% YoY CPI, which signals a cooling economy that could dampen the very AI PC demand Intel is counting on for its turnaround. The geopolitical landscape is a minefield of conflicting signals. While the CHIPS Act, the federal program providing billions in subsidies to bring chip manufacturing back to the U.S., provides a floor for Intel's Ohio and Arizona projects, trade policy is a ceiling. Renewed tariff uncertainty and tightening export controls on Gaudi 3 accelerators, Intel's dedicated AI training hardware, directly limit revenue from major Chinese OEMs. Revoked licenses for Core Ultra laptop chips further erode margins in a key regional market. As the market prices in a high beta 2.23 volatility, Intel is caught between being a national security asset and a global trade casualty. The capital rotation is favoring supply chain resilience over pure growth, making Intel's domestic footprint its primary macro shield. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%, a solid beat that signals strong execution. Intel is trending higher, currently at $126.30. Management's headline this quarter: forecasted outlook. 3 words that appear once in the 8K, yet dominate every analyst call. They're designed to make you feel Intel is back, steady guidance, predictable growth. What they don't want you to think about: the silence around how that outlook is built. Here's the decode. Insiders sold $6.5 million in the last 90 days. Miller Boise dumped $4 million. Chandrasekaran $2.5 million. That's not a tax move, that's a pattern. Historically, this level of selling precedes a margin reset or a node delay. The EPS beat? A 1971% surprise is not skill, it's accounting. Non-GAAP measures aren't reconciled in the release. They're buried in an exhibit. That's not transparency, that's a distraction. And R&D as a percentage of revenue dropped 16.8% YoY. $13.8 billion sounds massive until you realize it's shrinking while TSMC and NVIDIA are accelerating. That's not efficiency, that's a pipeline running dry. What management is saying is, we have an outlook. What the lab hears is, we have a spreadsheet. Last quarter, the phrase was record demand. This quarter, it's forecasted outlook. That's not a pivot, that's a downgrade in ambition. The Q&A is where the truth leaks. No transcript, but the 8Ks language shift is glaring. They're no longer leading with execution, they're leading with caution. And the CFO credibility score? A single vague line about awaiting actuals is how degrade finance teams buy time. Watch for R&D as a percentage of revenue to drop below 22%. The momentum breakdown for Intel. RSI sits at 54, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case for Intel rests on the successful deployment of high-NA EUV lithography to reclaim process leadership with the Intel 18A node. If Intel successfully ramps Lunar Lake processors this fall, they capture the AI PC market, the next generation of laptops with integrated neural processing units for local AI workloads, securing a massive hardware moat. But here's what breaks the bull thesis: execution risk on the 18A roadmap. Any delay in 18A production yields would be catastrophic, allowing TSMC to maintain its dominance with the N2 node. Furthermore, tightening export controls on Gaudi 3 and Core Ultra chips significantly limit Intel's revenue upside from major regional OEMs, creating a permanent drag on gross margins. The question that makes the room go quiet: can Intel's foundry services actually attract high-volume external design wins while the company is bleeding cash on fab construction? The lab's answer is that without a whale customer like NVIDIA or Apple committing to 18A, the foundry business remains a high-cost experiment. Intel's pivot to advanced packaging like CoWoS, chip-on-wafer-on-substrate, the technology that stacks dies to increase performance, is necessary but capital-intensive. The lab previously issued hold calls at $108.88 and $110.27. The stock has since climbed over 14%, proving our caution was premature, but the technical setup remains stretched. If Intel confirms a major external 18A customer by Q4 2026, expect a move toward $150 as the foundry thesis validates. If 18A yields miss the 60% threshold by year-end, the stock likely retreats to support at $99.17. The lab's call: stay neutral with an AI score of 63 out of 100. The 82.0x forward P/E leaves no room for the inevitable engineering hiccups. ARM's 7nm V9 yield pop is the signal that moves the needle today. Which of today's picks would you put real money on, ARM or Intel? Comment your reasoning. This isn't financial advice. We're here to break down the engineering, not sell you a position. Do your own research. Past performance never guarantees future returns, and markets can turn on a single wafer defect. Hit subscribe so you don't miss the next deep dive on the stocks Wall Street overlooks. The lab's out.